What's going on, guys? Today I just want to make this quick video talking about the VIG Dividend Appreciation ETF and what a portfolio might look like after investing into this ETF for 30 or 40 years. Just trying to visualize what the income might be like and what one can expect from this ETF. But by all means, stocks go up and down, especially with all the volatility going right now. This is just an illustration. But obviously some years are going to go up, some years are going to go down. But typically you could shoot for like a 6 or 7% on a conservative side return per year. So yeah, let's go ahead and take a look at this one. So if you invested $500 a month into VIG, VIG is a dividend appreciation ETF managed by Vanguard. They have a collection of stocks, and those stocks grow their dividends. And they're known for dividend growth companies. So you can see here the dividend growth rate is around 6.13%. They've been growing their dividend for 4 years. The yield was around 1.67%. You can see here it's been growing pretty consistently here. So let's go ahead and jump into the calculator. And let's say our starting principal is around $6,000, and we're going to continue to contribute $500 a month or $6,000 a year. So our dividend yield was 1.67, and the expected annual dividend increase per year, let's just put a conservative number of 5% per year. Let's say the share price is going to keep up with inflation around 2%. And we're going to say this is invested for 40 years. We're also going to say this is in a taxable account, 15% tax rate, and we are dripping our shares here. So let's go ahead and see. Okay, so you can see a nice upward trend here. Obviously this is just hypothetical. You are going to go up and down, but the average hopefully is going to be going in upward trend there. Our ending balance is going to be around $1.3 million with a return of 431%, average annual return of 10%. That might be a little bit more than what we might expect, so we might update the data just to give you guys a little bit more of a conservative illustration. But after 40 years, so year 41, you will expect a dividend income of $153,000. So you'll never have to sell off the shares that you've acquired. You just pretty much hold on to those, and those continue to grow, and it continues to produce you a pretty nice income. Something else to notice too, that these dividends are going to be qualified dividends, so that is also a great tax advantage as well. Our yield on cost ends up being over 60%, and then we actually received almost $1 million in payments that were invested back into our shares. So as you can see here, the snowball just starts and it continues to go as you continually invest. So that's the most important thing, just to stay with it. Consistency over the long term wins. Yep, and as you can see here, this is year 40. So if you go to 41, we'll be able to see the 153 here. Let's see, just show you guys real quick. So after 40, we're going to be looking at $153,000 per year. Pretty crazy, and that just goes to show you the power of compound interest. So let's just be even a little bit more conservative. That's the yield, the current yield, that's going to continue to grow up. But let's just say that it was only an average of 4% dividend increase and only a 1% share price. So, this is a very conservative number here, guys. They are typically going to probably average out to be more than 1% per year, but this is just, very conservative here. Even with that, you're still looking at a $68,000 dividend stream after 40 years. So, even with the very conservative numbers, you're looking at, almost $70,000 here. And that's just simply buying and holding. But there's other techniques that you can use once you have 100 shares, and that's covered calls. That's another way you can produce weekly and monthly income on top of this income, just to help even compound it even faster. So, I mean, that's pretty much it. So, there's different techniques. You can buy individual stocks, but this is just buying it, like I said, the ETF, VIG. Just go ahead and take a look at some of the holdings here, just to give you guys a better understanding of what VIG is. Consumer defense 17%, healthcare 15%, technology 13%, industrials 15%. So they are pretty balanced. But some of the holdings here are Walmart, Microsoft, Procter & Gamble, Johnson & Johnson, Visa, Home Depot. These are all nice dividend growth companies. But yeah, so by all means, you can buy these individual stocks, and you could do the same technique that we were talking about. Just investing consistently over 30 or 40 years. There is more risk with that. If a company just gets disrupted and another company pretty much just puts it out of business, that's a risk of when you're looking at a 40-year time horizon. That's why you could do it with an ETF, and just continually investing into that one. But yeah, these are good too. You could buy these and start selling covered calls with those. So that's another technique as well. But I mean, God, this. But yeah, I mean, just with these conservative numbers, typically I like to find ones that are increasing their dividend closer to 7 or 8% per year. Don't chase dividend yields. I mean, if you're a long-term investor, if you have like a long time horizon, there's no reason to be chasing after, stocks with 8 or 9, 10% dividend yields. If you're looking for dividend growth, but there's different special situations. Part of your portfolio can be QYLD, where it's a 11 or 12% dividend, but I just don't recommend, if you're looking for a dividend growth portfolio, to throw all your money in high dividend yielding stocks, just because over time, yes, currently right now you'd be like getting a nice yield, but the share price is just going to go down over the years. So definitely be careful with that. Some of the biggest advice I can give you is educate yourself, determine what you're looking for in investing, set goals before you even start investing. Learn different strategies, but then just focus, man. I mean, you could get distracted by so many different things. So yeah, determine the type of investor you want to be, educate yourself on it, and then get started. Timing the market is not as important as your time in the market. So as you can see, over a 30 or 40 year time, like you have years for it to go up and down because you have a long time horizon. Whereas, if someone's, closer to retirement, this might not be like a strategy for them, dividend growth. But I mean, if you have 10 years, I think easily, even, 10 years out, it could be a good strategy to implement. But by all means, this is not investing advice. This is just for educational purposes only. Do your own research. Take this, take the video that I gave you today, learn something from it, and then go take it to go learn and teach yourself more and educate yourself more. That's what it's all about, really. So yeah, I think that's pretty much it for this video. Thanks for watching. Be sure to hit the like button, comment below with any suggestions that you guys might have, and and your experience on dividend growth investing. And yeah, I'll leave the link to this website below so you guys can come here and plug in your numbers and take a look at it for yourself. All right, thanks for watching.